Good afternoon. Given the recent spike in market volatility and the significant drawdown experienced in global markets over the past week, we felt it would be appropriate to share a couple of thoughts. First, I think it's important to point out the global markets are essentially operating in an information vacuum. And whenever that happens, there's always a large surge in volatility as they struggle with trying to price the unknown. The real underlying concern to markets at this moment is the following. What is the potential economic damage to regional and ultimately the global economy? As the number of identified cases of the coronavirus continues to grow, potentially causing economic shocks as a result of quarantines, business shutdowns, and supply chain disruptions. Right now, the answer to that question at this point in time is completely unknown. So I would suggest it's far too early to draw any conclusions with any confidence as to if and how any changes should be made to one's investment posture. Our position is to stick with the investment plan that was created with your IG consultant in order to achieve long-term investment goals. This was based on your individual ability to accept risk, removing the potential of being whipsawed in a volatile environment as more information becomes available and markets begin effectively pricing that information. With that as a backdrop, let me now add a few additional comments. Staying invested and diversifying your portfolio ensures you are always capitalizing on the upside of the market and reducing the impact of short-term market volatility. As investment term increases, so does the probability of a positive return. Throughout history, equity markets have experienced volatility, yet despite this, they continue to be resilient. As this graph demonstrates, the S&P/TSX has delivered an annualized return of 8.93% since 1956. Over the same period of time, it has declined by more than 10%, a total of 24 times. Yet, each time the market recovered and achieved a higher level. In fact, many of the strongest returns in the market occur in the period immediately following a sharp decline. Since 1950, following the worst rolling 12 months periods of performance by the S&P/TSX Total Return Index, the markets made solid gains within the following 12 months. And within 5 years, the markets were up significantly, meeting and exceeding long-term return expectations. The US economy entered 2020 with historically strong momentum, driven by high consumer confidence and low unemployment. Although the shift that happened in the market last week was extraordinarily rapid, so far, it is no worse than a typical intra-year pullback. As the impact of the coronavirus becomes more quantifiable, volatility in the markets will ease. In closing, market pullbacks do happen, and attempts to avoid them more often lead to missing out on future and significant advances. In almost all circumstances, the fundamental key to successful investing is having a plan and the discipline to stay invested. Maybe as relevant today as ever, I'd like to think of the old adage, it's time in the market and not market timing that creates wealth.